Supermicrocomputer stock, SMCI DLC Solutions pave the way for near-term recovery, long-term growth amid AI tailwinds. The post-earnings sell-off in the shares of Supermicrocomputer Incorporated, SMCI, appears like an opportunity for investors who can ignore near-term volatilities and look at the larger picture. It is true that hypergrowth stocks get punished severely when something in the narrative is even least negative or weak. This is in a way good because the pullbacks or dips or fall in the stock offer an opportunity to buy into a quality stock. SMCI stock is already recovering as the knee-jerk post-earnings reaction wears off, and this warrants a deeper look. What caused the sharp pullback in the stock? SMCI missed Q4 EPS estimates by a wide margin and posted a sharp decline in gross margins. This led to the post-earnings sell-off. The SMCI shares closed trade on August 7 at $492.70, lower by 20% from previous day's close of $616.94. Non-GAAP gross margin for fiscal 2024 dropped to 14.2% from year-ago 18.1%. For Q4, non-GAAP gross margin fell to 11.3% from 15.6% in Q3. Adjusted earnings of $6.25 per share missed the consensus estimate of $8.07. A combination of factors like product and customer mix, focus on winning strategic new designs with competitive pricing, and higher initial costs in ramping production of new DLC AI GPU clusters were cited as the reasons for the gross margin decline by the company in its Q4 earnings call. SMCI's direct liquid cooling DLC, which powers AI data centers globally, is touted to be more cost-efficient and less environmentally taxing versus traditional air-cooled data centers. While the market focused on the negatives, SMCI left plenty of good takeaways in its earnings call. Here are a few. SMCI anticipates that short-term margin pressure will ease and return to normal ranges before the end of fiscal 2025, which is before June 2025. Company said it can improve gross margins to the target range of 14% to 17% by improving DLC manufacturing efficiencies. SMCI believes that its leading position in DLC total solutions will be instrumental in increasing its profitability, alongside its Malaysian facility coming online later this calendar year. SMCI is targeting 25% to 30% of the new global data center deployments to use DLC solutions in the next 12 months. In the coming years, SMCI sees existing air-cooled data centers to transition to DLC liquid cooling because it could save up to 40% in energy costs for the data center customers and boost computing performance, while reducing lead times, the time to come online, because of less electrical power requirements. Last but not the least, DLC would reduce carbon footprint significantly. Building new AI-ready data centers takes an average of 3 years. SMCI claims that its upcoming Supermicro 4.0 DCBBS data center building block solutions will reduce this timeframe to 2 years, and for smaller facilities or old data center transformation, the timeframe would come down even further to less than 1 year or in just 6 months. SMCI is offering DCBBS later this calendar year. This could be a key growth catalyst for SMCI. SMCI said it is entering fiscal 2025 with record-high backorders, winning products, large volume DLC liquid cooling capacity, data center BBS, and more new customers. This could position it for long-term profitability and growth, even if its investments hit short-term profitability. This appears like a very reasonable argument. The shortage of key components pushed about $800 million of revenue shipments into July, lowering its earnings per share (EPS) for the June quarter. However, this revenue will be recognized in the September quarter. For the September quarter, the company guided for adjusted earnings of $6.69 to $8.27 per share, versus consensus of $7.58 per share, on revenue between $6 billion to $7 billion. Versus consensus of $5.52 billion. In the year-ago period, SMCI earned an adjusted $3.43 a share on sales of $2.12 billion. SMCI sees fiscal 2025 revenue between $26 billion to $30 billion versus consensus of $23.6 billion. Bottom line, SMCI stock trades at just 1.2 times its forward sales, but appears well positioned for recovery in the near term and for significant growth in the longer term, thanks to its DLC solutions amid the AI boom that is motivating the accelerating growth of AI-ready data centers. The turmoil of the indices last week dampened investor sentiment over concerns that AI investments were cutting into profits of the mega-cap techs, and the correction could be the beginning of a deep sell-off in the higher-for-longer interest environment. However, market experts realized that unwinding of yen trades by hedge funds had caused the sharp decline, and the broader indices recovered nicely as the week ended. Disclosure: I do not own any SMCI shares, but I may or may not initiate a position in the next 72 hours. Cautionary statement: please note that I am not a registered investment advisor, and readers should do their own due diligence before investing in this or any other stock. I am not responsible for the investment decisions made by individuals after watching this video or reading this transcript. Readers are asked not to rely on the opinions and analysis expressed in the video, and encouraged to do their own research before investing.